All right, let's get right into it. In the last 120 days, over 200,000 people, specifically in the tech sector, have lost their jobs. So you may be thinking, well, I don't work in tech, so why does this even matter to me? This might be the warning sign of something way bigger. Layoffs don't happen in a vacuum. The last time we saw mass layoffs like this, we were heading straight into 2008's financial crisis. So the real question is, are these job cuts just tech companies trimming fat, or is this the beginning of a recession? And today we have Matt Floyd, our guest host. Matt, how are you doing today?
I'm doing great, Kevin, and I'm really excited you asked me to guest host. It's kind of going to be like a day in the office where I pick your brain and you just start talking.
Yeah, that's funny, but there is a lot of truth in that. So I thought, we've had a little bit of discussion about this. I thought, man, let's get Matt in here, and you can ask me these questions. So, um, and also, yeah, I mentioned, when I was talking about doing this podcast, that I probably need you to rein me in, help me simplify everything so that I don't go off the rails and geek out on economics and forecasting markets and, which is what my old life was. So
Yeah, no,
we
I
got
mean,
a
I'll
tall
try to
task here.
rein you in, but I kind of like when you go off the rails because I pick up so much from you, And so today we're getting straight answers from someone who's been in the trenches. My guest is Kevin Ross, a former Wall Street economist and institutional bond trader who's navigated market meltdowns, inflation spikes, and economic crises firsthand. Kevin, welcome to Plan Life Right.
Yeah, that
You kind of have a funny story about the first weeks of trading after you got your Series 7 license. Why don't you let everybody know about that?
yeah, that's man, I'm going way back. So I studied for my Series 7. When you get out of college, a lot of times you think, oh, thank God I'm done with I'm done with all the studying. And I had this book because, back in the day, they didn't have really the internet cranking like it is today. It was all dial up. So this would have taken forever. So I had this, I don't know, it was probably this thick of a binder. It was larger than any book I had in school. And I had it studied for the Series 7. So I went right out of college into working for a institutional firm, Wall Street, and they said, "Hey, you got to study this. If you don't study this and pass it, then you need to find another job." So a lot of pressure right out of the gate. That was only the beginning of it. So I passed it. I actually passed it the week before the stock market crash, as everyone called it, Black Monday.
Yeah,
And
it's
so
1987, right?
that was in '87. Yeah,
Yeah,
I
I
made
won't
you.
make you feel old. I won't tell you how old I was when that happened.
Oh God. Yeah, well, probably some of these podcasts or these listeners here to this podcast weren't even in a born or thinking, or their parents weren't even thinking about making them. So that's all right. So with age comes wisdom, which is one of the reasons why we call it playing life right. Life happens fast. I can't believe that all this time has passed, and I've got three boys that my wife and I've raised, and it just seems like yesterday, you know, we were walking down the aisle, and also me starting this great new job out of college, um, and here we are. Black Monday hits, and so that was when the stock market crashed, and
And
so
what was it like being in the trenches on Black Monday?
well, they were like, my nickname was Country because I was from Tennessee, and I had a Southern accent, and so they called me Country. And they're like, Country, pick up the phone. So the phones are going nuts because what happens when the stock market crashes? Um, there's a thing called flight to quality. So people like large institutions, they were selling their stock positions, and they need to go into bonds for safety. So flight to quality is what it's called. So
Yeah,
I'm
I saw a
answering
little bit of that when I
calls.
was at JP Morgan too. we saw a number of clients were leaving those small community banks and they wanted to go to one of those too big to fail banks. And JP Morgan was one of those. So we saw that flight to quality firsthand.
Yeah, in '08, right? Yeah.
Yep.
Yeah. So you see this. This is a phenomenon that won't go away. We're seeing it actually in today's market where we've got all this volatility. The market this week has been off, and for the year we've given things back. So, and what we've seen is the yield on the U.S. Treasuries drop because of flight to quality. So people are selling their stock positions, not individuals, because when by the time an individual reacts to whatever stocks they own, the institutions have already done it. I mean, they're 5 to 7 steps ahead. And it's because they've got all of this algorithms they've created and all this stuff, and it's been tested throughout time. And so these guys tweak it, and these are the smartest of smart people that are running this institutional money. So a poor little lonely individual stock player, we're missing stuff. By the time we execute, the institutions probably sold out 3 or 4 weeks ago, major positions, and people don't realize it. Now they're sitting there holding the bag of, a stock that's given up 15, 20% already this
Yeah. I
year.
mean, it's
So
kind of like trying to win the Indy 500 riding a horse, basically.
it's a great analogy. It is kind of like that. I like that. So,
Yeah, you
so
were saying the stocks, they've already given back all of their gains since the election. I mean, election day happened, markets went on a tear. I mean, the Dow, the Nasdaq, S&P 500, all were sailing, and then just in the last 30 days, they've given all of that back, and now we're dipping into the negative.
that's right. That's right. I mean, we're seeing a flight to quality as we speak. I think we're going to continue it, and as we go through today's podcast, we're going to talk. I'll give a little. Here's what I think 2025 is going to be for whatever it's worth. I mean, I used to um, get paid to to make those calls for our institutional investors. This is what I think, and let's be real. You can like economists. I've always said they're kind of like weathermen. They're right as often as they're wrong.
Right.
I mean, when I was living in South Florida, it was kind of really easy because you knew between 3 and 4 o'clock you're going to get a pop-up shower. I mean, that was a given. So maybe a little easier in the tropics, but even here in Tampa, it'll rain somewhere and not in the other place. And so, like I say, that's kind of the economist. You could always line us up in a row, and half will be on one side and half will be on the other. But we'll talk about that as
Yeah.
the call goes
Well, I
on.
think a good place to start are these three words that we keep hearing. I mean, I'm seeing them on Instagram, I'm seeing them on the news, I'm hearing them on the radio. Inflation, deflation, and stagflation. And I think most people, they don't necessarily feel what does it mean in their daily life? I mean, you hear about inflation, but how does it impact your wallet at the grocery store? We keep hearing about eggs, but can you break those three concepts down for us in plain English, not Series 7 bond trader stuff?
Yeah, wow, that's a tall task. I, uh, I will do my best, and if I get off the rails and go too deep, just bring me back in.
Okay.
So what I'll do here is I'll talk about it kind of in personal finance terms. So,
Yeah,
so
I think that makes the
inflation.
most sense. Yeah.
So inflation. Imagine you make $5,000 a month, and then suddenly gas, groceries, rent all go up. But guess what? Your paycheck stays the same. So you can afford less now. That's inflation. And we've had a strong dose of that during the previous administration. And what happens is we learn to adjust, and we adjust until we can't adjust anymore. And I saw this morning actually on the news, and they were talking about 14% of Americans have had to take on a second job to just make ends meet. And so that brings me to the next piece, which is that you asked about, which was stagflation. So we've had this inflation where, we kind of, you know, try to make it, we shrunk a little bit, but maybe we borrowed money, we put it on our
Yeah,
credit
tighten
card,
the
but
belt a
now
little
everything's
bit,
back.
start using coupons,
That's
start
right.
getting the buy one, get one offers, going for off brand. You can kind of stem the flow of those rising prices by making small adjustments, but you can only tighten the belt so much.
That's right. That's right. And so it gets me into stagflation. So imagine those prices keep rising, but your hours at work get cut. So now it's not only that life is more expensive, but you're also making less money. And
Yeah.
that's stagflation. To simplify it, it's
So it's a
very well.
double-edged sword kind of. You're making
It,
less and you're spending more regardless of what you can do to kind of hold that
exactly.
back.
It's really the worst of both worlds. It's you really feel that the squeeze here. So, if you go back to the 70s, and even I was a little too young to know what was going on then, but because I studied economics and majored in that, and I got a pretty good understanding because that was in the 80s, that was the most easiest thing to look back to, the most current. Um, so I have, a little bit of understanding of what was going on in the 70s through, not living through it, not per se, but understanding and studying it. And
Well,
then
you
there's
kind of got to see
deflation.
you
What's
kind of
that?
got the Monday morning quarterback view of it because, it happened in the 70s and you're learning about it in the 80s. So the analysis and the data was there for people to analyze. And I guess they kind of saw which missteps were taken.
That's right. That's exactly right. So it, it's always easy to Monday morning quarterback, right?
Yeah.
So
Well, I mean, now inflation's horrible. Stagflation's worse. Deflation, that's got to be good, right?
Well, you would think so,
Yeah.
because what deflation means that prices drop typically, but it drops because people stop spending. So it sounds good, but if businesses make less money, they start cutting jobs. And
Right.
before
So
you
it's
know
that
it,
supply and demand coming into play again. Demand goes down while the supply is up. They got to cut the prices to liquidate the inventory.
exactly. So when they start cutting jobs, guess what? People can't afford anything because they don't have a job. That's deflation. And that happened in the Great Depression. Um, we've seen little bouts of it, in the last 40 years. But the deflation that we experienced, and we experienced in 2007 through 2009. That's probably nine. That's probably that is the most recent. And what the country experienced a period of falling prices. Um, and in 2009, that's when we really saw it. I mean, you think about home prices lost 40, 50, 60%. And people they just stopped paying their mortgage. They're like, why am I paying for something that's worth 60% less than what it was when I bought it 3, 4 years ago? So people were turning in their keys. Then guess what? Now all these banks own all this real estate. And I will tell you that banks are the worst um, owners of real estate. They're the worst real estate investors in the history of mankind. As a matter of fact, I was trying to buy a house in Palm Beach that was uh, in foreclosure. So the bank owned it. I bid back a price that I thought was fair. They said no way. They held it. So I went on and bought another house, and that house ended up selling for $50,000 less 3 months after I put in a bid. So that's a perfect example that I lived real life. Banks have zero clue. So if you're a banker listening to this, I'm sorry. And you may not know that you don't have a clue until you get out of the bank and realize you and your bosses have no clue on how to manage distressed real estate.
And there's still
Um,
hope for you because knowing's half the battle.
exactly. So the impact with deflation is you typically follow with inflation high unemployment rates exceeding 10% at its peak, which just further strains the economy. The Great Recession back in 09, the U.S. hadn't experienced such a widespread deflation since the Great Depression, and although certain specific goods and categories of those goods, we saw price declines. We saw groceries decline. We saw even gas decline. We saw a lot of prices decline, but the fact of the matter is that a lot of people couldn't afford it because they were out of a job, and they couldn't. They had to go now rent houses. Sometimes the bank owned,
Yeah,
because there was nobody. The banks wouldn't lend any money either, so we had
right.
just this real true shrinkage of the economy.
You know, and you hope your credit isn't shot from going through the recession. So where your credit is good enough to even be able to rent a spot, and you're not, trying to borrow a room at your neighbor's house. But let's add another layer to it. Home prices in some Florida markets, they're already down 30% from their peak. Used car prices are dropping. Mortgage rates are still sky high. I mean, there's been a little bit of a dip in the mortgage rates, but they're still pretty sky high, way, way above what I got my mortgage at. And there's something else. Restaurants that have been around for decades, fixtures on the main drags everywhere, they're shutting down left and right. Red Lobster out of business. Hooters is going out of business. Applebee's is starting to shut a lot of locations. I mean, we're seeing long-standing chains close locations nationwide. So let me ask you this. What if we're already at stagflation and we just don't realize it yet? We have slowing home sales, dropping car prices, layoffs are piling up, and it's not just tech. I mean, you got the federal employee layoff, you have all these tech layoffs. I mean, that's checking a lot of boxes, isn't it?
Matt, that's a great question, and it is. Stagflation's tricky. It doesn't hit overnight like a market crash. It creeps up, and to your point, we're seeing some of the classic signs right now. We've had high inflation. We continue to have inflation. Um, we have slower economic growth, and we're starting to see a little slight rise in unemployment, especially in certain sectors. And typically, the tech sector is the precursor of a market downturn. So, if cash continues to be hard to acquire for companies, the big companies, they'll do layoffs. They've got cash. They're not tech centric where they're more in demand, cash in demand type of scenario. So once you start seeing these larger sectors, and as you mentioned, we're seeing it in some of the restaurant chains, it could be a big indicator of stagflation, right? So because that's when businesses and consumers both feel the squeeze, so they're paying more for necessities, for example, eggs that we're all experiencing right now. That's a one-off, though. That's the bird flu that's causing it. We have seen some of our prices drop. I mean, chicken at one point was $7.99 a pound. It still may be at Publix, but you can get it at Sam's or Aldi's for under $3 a pound. So at least here in the Tampa area. So we've had a little bit of squeeze here. The eggs, we're all feeling that, but I think that's kind of a one-off. But anyway, so you're paying more for necessities. You don't have that income, and then businesses, they end up they're not able to raise prices anymore because people can't afford it. So they start shutting down locations, and that's what we're seeing in a lot of these large restaurant changes. The cost of goods skyrocketed. Okay, so it costs the restaurants, they had to spend more to get the food, right? But then also wages increased, so they had now to pay their employees more, and it squeezed it. they were raising prices. I mean, if you've been to a restaurant and you look at what a restaurant price is today and what it was 3 or 4 years ago, I mean, it's night and day. If we could go back and go to a 2020 or 2019 um, menu, you'd be like, feel like I'm stealing the food. And that's how your brain kind of gets used to, it's inflation and you're making these changes. But then all of a sudden, you're at a point where I can't I can't afford it anymore. So you stop going to the restaurants. You quit spending the money. So these restaurants start, shuttering. And you mentioned that your one of your favorite restaurants, Hooters. I couldn't believe that of all places is closing some restaurants down. But it's because of higher wages and higher cost of food. And there's a price point where people are like, I'm not spending $40 for lunch for beer and wings. That's
Yeah,
too
you can go to
much.
the grocery store and buy the Hooters breading and the wing sauce right at your grocery store now for, pennies on the dollar of what it would cost you to go to the restaurant, and you don't have to tip anybody.
Exactly. I certainly think that we are in an inflation slowdown, but the big question is do we slow down too much? So that
Right.
this comes to the Federal Reserve, and Trump and the Federal Reserve Chairman, they're not seeing eye to eye.
Yeah.
Trump wants to be aggressive on it because it'll spark spending because it'll lower the lower the cost to buy things to get to borrow. The borrowing costs will lower if the Fed decreases rates, but the Fed doesn't want to do it. They're kind of in a holding pattern right now. And then they've got to manage if they raised rates pretty aggressively. They made a cut before the election. Some people think that was a political move. Maybe it was. They were hoping it cooled inflation, but it really hasn't done that much. And so the response that we're seeing now is we're seeing some corporate layoffs, right? And we're seeing companies across the board, some of the service industries specifically are starting to cut jobs. And so when all this happens, demand falls, and then things could spiral into recession. So I've always said on stagflation, that's kind of your Monday morning quarterback. You don't really realize you're in it until you're into deflation and you're looking square in the eyes of a recession. And
Right.
so that's what the Fed tries to manage. They don't want to go too aggressive, but they can't stall out and just let the high interest rates, the borrowing costs remain so high that people can't afford anything. So they're in a tricky situation, and 2025 is going to be a big telltale sign of
Yeah.
things to come.
Well, let's talk about the 200,000 tech layoffs in just 4 months. I mean, what's the real reason behind it? Are companies just cutting costs? Is this AI coming in and starting to push people out of jobs, or is this a warning sign of something even bigger?
Well, it's, it's a really good question. Layoffs in the tech sector are always an early signal because tech companies react faster than traditional industries.
And they tend to be a little more bloated than most industries, right?
That's right. I think right now we're mostly seeing tech adjusting, but if we see layoffs spread beyond tech, uh, in the retail sector, in the manufacturing sector, and in finance, then we've got a real problem. So, think about during COVID, companies like Amazon, Google, Microsoft, they went on a hiring spree, right? And everybody got to work remote. So all the tech junkies loved it. They didn't have to go out, go drive to work anymore. Uh, they they got a cool job at Amazon, Google, or Microsoft specifically, but there are 1,000 other tech companies that were doing the same thing, and they got really bloated. Then we had an economy that started to slow down. Interest rates shot up, and suddenly, in the last, over in 2024, those companies realized that they overhired, and so you started seeing even in late 2023 And throughout 2024, you started seeing these tech companies start making small layoffs. But now they're really starting to cut jobs, in the last 120 days. So, you know, part of the last quarter of 24 and then the first couple of months here in 25, we've seen these tech companies really make some aggressive layoffs to the tune of 200,000. And those are typically high income earners that were taken out of the economy. And so if you think about it from a little bit bigger picture, not just that individual, but what these high rate wage earners do, that impacts real estate. Okay. So maybe they bought a bigger house because they were working out of their home. Now they've got to downsize, but guess what? They bought their house in 2021 or 2022 at the high. Now the housing prices in some areas are down significantly. You see it in car sales. Used car sales have dropped. I mean, 2020, it was ridiculous. The car sales, you're actually selling a used car for more than you bought it when it was new. And that was a supply chain issue, right? Because you had the world kind of essentially shut down. So when those 200,000 high income earners are removed from the economy, real estate they're not buying any nice cars, luxury goods. They're not buying a new fancy watch because they can't. And then travel, they were going to go on a trip and then travel starts to shrink. So they're not even able to do that.
And they got to be high income earners, because when the company's looking at, like, when they're staring at that bottom line and they got to make a bunch of layoffs, they're not firing the $55,000 a year guy right out of college. They're getting rid of the guy making four times that's been at the company 10, 15 years. It's got a decent pension. You know, he's got a parking spot. He's got a company car. He's got all the perks that are costing the company money. So those are prime targets for layoffs when we come to a stagflation situation.
Yeah, it's really a red flag,
But I mean,
more
you
than a
said
good
car
sign.
prices are dropping. I mean, and used car prices in particular. But isn't that a good sign? I mean, it's not. It's a red flag to you. It's not a good sign.
Yeah, it's really I think it's more of a red flag. I mean, initially people are probably thinking, "Oh my gosh, man!" And you look at the the marketplace, and you're seeing these cars start to 0% interest, even though interest rates are high. They're knocking the price off of it. So we're starting to see it sounds good, but there's a ripple effect here. So, why things are getting cheaper, fewer people can afford them. That becomes a demand problem. So
Gotcha.
think about it. Car dealerships aren't selling cars, so they order fewer from the manufacturers. The manufacturers have now got to slow down auto production, which is not what they're designed to do. And then that affects jobs. So they start cutting back the hours, right? That kind of sounds like stagflation a little bit.
Yeah.
Then when they're not building as many cars, that affects the steel that goes in it, the plastic that a lot of cars are made out, rubber, electronics, and then also the bank lending. Think about it, because fewer people are taking out car loans. So it's this ripple effect.
Well, and the loans they're taking out are smaller because the prices are lower.
Yeah, it's kind of it's simple. People can't afford homes at current interest rates. A mortgage payment on $400,000 house is way higher today than it was 2 years ago because of the interest rates. That's sidelining buyers. We've had a increase in property insurance with these last two hurricanes that hit on the West Coast. It's making it almost borderline absurd, the increase in homeowners insurance and the cost of owning a home here in Florida now. And then to top it all off, you've got power companies that are passing on the cost of the hurricanes. So,
Well, and it's
they
kind of
say it's
like,
18 months, but
I
I
think
don't
another
really.
thing sidelining buyers is the fact that the prices are going down. And there's a lot of people that are just saying, hey, well, that house we were looking at, it already came down $10,000 from last month when we first found it. Why don't we wait another month and see what happens? And then let's wait another month and let's wait another month. And it's a low tide that's affecting all the boats. It's just bringing it all the way down. And then I mean, I'm sure that also has a ripple effect. If there's not as many people buying houses, where are they getting the furniture for them? So you got probably, I would imagine, like IKEA or rooms to go. They're going to start feeling it too, right?
That's right. And it's not just the home prices, it's the entire economy that depends on the housing. So you mentioned when homes sell slow, furniture sales drop, appliance sales drop, moving companies lose business, and then the home improvement stores see fewer projects, right? They're not hanging curtains and blinds and all that.
And
It's
probably
all
even the trades
connected.
feel it too. The pest control guys probably feel a little bit of a squeeze. The guys that come spray your grass and make it green, I'm sure they also feel the squeeze because it ripples downstream to everybody that's involved in any aspect of home ownership and home maintenance, basically.
That's right. It really, you think of everything that you spend on a home on just a monthly basis. You're trying to get a bigger home, a new home. And now you've got the home builders that are sitting on inventory, they're cutting prices. You know, I always tell this story about, deflation. So we've got a family that's growing, right? They've just had a new baby, maybe a second baby or third baby. Now their home's gotten too small. So they're growing out of their house. They need more home or house. But in order to trade up, guess what? They got to sell their smaller house to move into that bigger house. So they got to sell their home first. Well, if people can't afford these high costs, and yeah, to your point, we're seeing this price drop, it drop, it drop. Well, you got to sell your own house. So it's this continual just push of ripple. And the person that was looking at first time home buyer, like you were a few years ago when you bought the house before you grew your family, they can't afford it either. So it's just a snowball effect that happens. So the big question here is how long will it last?
Well, I mean, let's get practical. If you're listening to this and you have a job, especially in a tech sector, what should you be doing right now?
First, don't get comfortable. Even if your job feels safe because you're not in the tech sector, don't get comfortable. Companies are watching their bottom line now more than ever. Get your finances in order, build an emergency fund, and make yourself indispensable at work.
Yeah, I mean, you can look at it doesn't matter how great you are at your job, doesn't matter how many wins you've racked up, everybody is expendable at some point, and you don't even have to look any further to that point. Tom Brady, probably the greatest quarterback of all time, he was cut from his job because they deemed him indispensable, past his prime. We're not going to get much out of him anymore. And he had to dust off his resume. I'm sure he wasn't prepared for that.
Yeah, that guy, he made it. He's doing okay.
Yeah. Well, what if you run a business? What's the smart move right now? If you run a business, tech, retail, manufacturing, whatever it be, what would be the smart move as a business owner?
So if we are heading into a slowdown, and I personally think we are, it's now time to be lean and mean. So cut unnecessary expenses, focus on profitability over growth, and watch your debt. Because if interest rates stay high, borrowing will only get more expensive. And if we go into deflation, banks don't like the loan, so money gets tighter. It's harder to borrow.
If only there was a way to borrow money without having to go to a bank. I
Yeah,
think I
that's
think
a
I might
whole nother
have a
show.
strategy or two about that.
Whole
What about
nother show.
investments? Stocks, like we said, they're all over the place. We were on a tear right after the election, and now we're in the dip, and we've dipped below where we were pre-election. What's the best strategy here for stocks?
Well, I think so. If layoffs keep increasing, that's a bad sign for tech stocks. But defensive sectors like healthcare, utilities, consumer staples, they tend to do well in uncertain times. Also, bonds, we talked about flight to quality, they're back in play. Yields have been falling, which means the investors, especially institutional investors, are preparing for a slowdown.
So let's connect all the dots here. We've got tech layoffs, we've got falling home prices, car prices are dropping too. Restaurants are closing, stores are closing, and people that have money are keeping it in the bank. They're not spending it. So is this the start of a recession, or are we moving toward deflation? We're stuck in a stagflation without knowing it, and we're now moving towards deflation. What are your thoughts on that?
Well, right now, I think we're probably experiencing some stagflation.
Okay.
We don't have the high employment piece of that equation. We're not in full deflation yet, but if we continue to see layoffs and we see consumer demand continue to decrease and collapse, prices keep dropping, then yes, we could see a deflationary spiral. And that's dangerous because deflation can lead to deeper recessions. So here's the deal. If layoffs spread beyond tech, consumer spending slows, and businesses stop hiring, then yes, a recession is on the table. So in the next 3 or 6 months, they're critical. If job losses continue to climb, expect the Fed to start cutting interest rates to stop the bleeding.
All right. So, Kevin, so what would you say? What is the best case scenario?
Well, it's like best case scenario, the Fed pulls off a soft landing. So inflation keeps cooling. Layoffs don't spread beyond too far beyond tech. Um, and if that happens, fingers crossed, we avoid a full-blown recession.
And I'm almost scared to ask, but what do you see as the worst case?
Well, worst case, layoffs hit multiple industries. Spending crashes, meaning people quit spending money on things other than just the brutal necessities. And the Fed reacts too late. So it pushes us into a stagflation or even a prolonged recession. So whether you're an investor, a business owner, or someone just trying to keep your head above water, it's not the time to panic right now, but it is a time for you to take action. The people who win in times like these, so in 2025, are the ones who see the trends early and make smart moves.
So they're ahead of the curve and they're there for those turns.
Exactly. You gotta ask yourself, what are you doing to prepare? Are you building up cash reserves? Are you looking at defensive investments? Are you making sure that you've got the right financial strategy for this kind of market? So bottom line, you got to stay informed. You got to stay flexible. Don't ignore the warning signs. Don't stick your head in the sand. The people who pay attention now will be the ones who come out ahead. And if you're out there listening, wondering how to navigate this economy, whether it's your investments, your home, your job, or your retirement, make sure you like, follow, and visit planliferight.com. We'll keep breaking this down and giving you the real insights to help you stay ahead of the game.
No, and let me say this, if you're a financial advisor who's out there listening right now, and you want access to clients who are actively looking for retirement solutions in a volatile market like we're in, connect with me. You can find me at advisorrescue.net, because this is the time when people need real guidance, not guesswork. And if you found this episode valuable, subscribe and share it with someone who needs to hear it. I've been Matt Floyd. This is Kevin Ross.
Right on. Hope everybody found this informative. Everybody have a great week.